Okay, let's get into it. Welcome, everyone, to the deep dive. Today, we are embarking on a pretty heavy investigation, one that tackles probably one of the most fundamental questions facing the economy right now.
A huge one.
Yeah, a huge one. Why is it so much harder for young people to get ahead?
Mm-hmm.
We're going to be focusing specifically on this widening generational wealth gap. We're going to pit the experience of the baby boomers against the financial realities of millennials and, of course, Gen Z.
We really have to stress, for you listening, you've given us an incredible stack of sources for this. We've got everything from these super granular market reports dated Q3 2025, all the way to deep historical analyses on housing trends, purchasing power.
It's a mountain of data.
It really is. And that's why our mission today is it's crystal clear. And it is purely data-driven.
No anecdotes.
No anecdotes. We're conducting what is essentially a forensic investigation into the structural shifts that have happened in the economy over the last, say, 50 years. We're not interested in opinions or, personal stories. We are solely focused on the hard numbers to see if the financial architecture itself has changed.
Right. Not just how people are playing the game, but if the game itself is different.
Exactly.
And the numbers that define this change, this structural divergence, they're truly profound. I mean, if we had to boil this entire deep dive down to just two metrics, two numbers that define this new economic reality, here they are.
And they are shocking.
They really are. First, we have the comparison of purchasing power. So when we look at a Gen Z dollar today versus a baby boomer dollar when they were in their 20s, the difference is an astronomical 86% deficit for Gen Z.
86%.
Your dollar today buys 86% less of the crucial things you need to build a stable life.
Just stop and think about that. 86%. That figure immediately shits the entire conversation. This isn't about, personal finance management anymore.
No.
This is about systemic economic engineering. It shows a massive, almost unbelievable transfer of value across time.
And the second metric, which, this one hits home for anyone trying to establish a family, a foundation, it's the time required for a young family to save for an average home deposit. A typical young family, say in the 1980s, needed about 3 years of disciplined saving to get that deposit together.
3 years. That's manageable. You can plan for that.
Exactly. You can see the light at the end of the tunnel. Today, that exact same discipline effort, it now requires 19 years of saving.
Wow.
From 3 years to 19 years. The financial timeline for just achieving basic stability has been, it's been radically altered.
And those two data points, they really define the core thesis of our investigation today.
Yeah.
We are analyzing whether the unique structural tailwinds that the boomer generation enjoyed, the things that allowed them to accumulate this unprecedented wealth. We're asking if those tailwinds created an economic environment that is simply unrepeatable. Or, maybe worse, an environment that's actively hostile to the generations that followed.
So the question isn't just, does wealth inequality exist? We know it does.
Of course. The question is, how deeply embedded are the barriers to entry now? Is the system itself fundamentally different?
So let's establish that towering baseline. We really have to understand the starting point, the sheer scale of the boomers' dominance to get this. We're looking at the cohorts defined by the Federal Reserve. So boomers born between 1946 and 1964.
Then you have Gen X, 65 to 1980.
Right. And then millennials, 1981 and later. And when you look at the data, the staggering scale of wealth that the boomers accumulated, it just jumps off the page.
It's unequivocal. They are, without a doubt, the wealthiest generation in U.S. history.
Period.
Our source data, which is current to the end of 2024, it shows that boomers controlled more than half, 51% of all U.S. household wealth.
More than half of everything.
And that actually peaked a few years ago, around 2021, at 53%. So it's come down slightly, but their collective net worth, it stands at $82 trillion.
$82 trillion. That's a number that is so immense, it almost risks losing all meaning in a conversation like this. How do we even begin to contextualize that scale for someone listening?
Well, let's try to break down the concentration. That $82 trillion net worth is more than double the wealth held by the entire Gen X cohort, which sits at $42 trillion.
Double, okay.
And it is 4 times the wealth of the entire millennial generation. 4 times. Millennials are at around $16 trillion.
4 times the wealth of the next biggest generation coming up.
Exactly. And to push that context even further, that $82 trillion trove, it equals roughly 2.8 times today's total U.S. GDP.
So nearly 3 years of the entire country's economic output is just sitting with one generation.
Yes. And consider the historical comparison for a second. Even back in 1929, at the absolute peak of the Roaring '20s, the entire U.S. household wealth was only valued at about 4.5 years of national income. And crucially, that wealth was far more broadly dispersed across the different age groups.
So what we're seeing now is different.
What we're witnessing now is a completely unprecedented concentration of capital in a single aging demographic.
That level of concentration, it points to more than just people earning high salaries. It suggests there were structural advantages, tailwinds as you called them, that were sort of inherent to the economic architecture of their time.
That's the key.
So what are the major mechanisms that the data identifies that allowed this $82 trillion accumulation to happen?
Well, our sources really identify three primary structural tailwinds that all converge to benefit the boomer generation in a really unique way. It's like they hard-coded their wealth accumulation into the system itself.
And number one is, I mean, it's always the most contentious, but the data here is just relentless. Affordable real estate.
Affordable real estate. They benefited from a historically low barrier to entry.
The barrier was just lower.
So much lower. The initial capital outlay, the down payment for housing, it was a fraction of what it is today. Let's look at the numbers. In 1970, the median existing home price was $23,600.
$23,000.
Now, when you rigorously adjust that for inflation to 2024 dollars, that price point is approximately $200,000.
Okay, so a $200,000 median home price in today's money.
Yes. And that $200,000 median price is less than half of the current U.S. median price, which sits at around $420,000.
Less than half. So just to be clear, if a boomer was buying a home in 1970, they got into the market at what is now the equivalent of $200,000.
Correct.
So not only did they then enjoy this massive appreciation from that point on, but the actual capital required to leverage that asset was profoundly smaller relative to their early career earnings.
It created a massive instant capital base. That's the perfect way to put it.
Yeah.
And look, people will say, well, boomers faced high interest rates in the late 70s and early 80s, and they did, sometimes 15, even 18%.
Right, the famous high interest rates.
But they were paying that interest on a far, far smaller principal amount. The leverage they had was enormous, and their ability to pay off that principal quickly, especially as real wage growth was outpacing inflation, was just unparalleled.
Do we have data on that debt-to-income ratio?
We do. The average first-time buyer home purchase in 1975 meant taking on debt that was roughly 1.5 to 2 times their annual income.
1.5 to 2 times your salary. Okay.
Today, that ratio is frequently 4 to 6 times your annual income.
Wow.
A completely different level of financial risk.
So once they own that core asset, that affordable home, they then benefited from the second major tailwind you mentioned, the stock market tailwinds.
Yeah.
This is where their personal savings really started to compound, right?
This is the accelerator. The data shows that U.S. stocks saw, on average, 10% plus annual growth during the boomers' key accumulation phase.
Their prime earning years.
Their prime earning years. This was a sustained, half-century-long bull market. We can even quantify this compounding effect.
Yeah.
A person who invested just $1,000 in the S&P 500 back in 1975
Just $1,000.
would have seen that single investment grow to roughly $32,000 by 2025. And that's calculating for inflation-adjusted total return.
32 times your money in real terms. That's an incredible compounding engine. But the system also changed policies to encourage them to use it, didn't it?
Absolutely. This wasn't just a happy accident of the market. The introduction of the 401k retirement plan in 1978 provided the perfect tax-advantaged vehicle at the precise moment this massive equity bull run was beginning.
Perfect timing.
It accelerated their accumulation of capital and wealth in a way that just wasn't available to previous generations, whose retirement savings were mostly in, fixed income or cash-based accounts. The silent generation before them, for instance, had much lower stock market participation. They were still fearful after the Depression, and the 401k policy didn't exist yet.
And that leads us right into the crucial third advantage, which speaks directly to long-term security, pension coverage.
Yes.
This is where the transfer of risk becomes most apparent to me.
Defined benefit pensions. They are the absolute gold standard of retirement security because they guarantee a specified income stream for life. The employer or the state funds it, manages it, and takes all the risk.
A guaranteed check every month.
A guaranteed check. And the sources indicate that more than half of late career boomers still qualify for these defined benefit pensions. That is an immense security blanket.
Okay, now contrast that security with the current generation entering the workforce.
It's night and day. For millennials and Gen Z workers under 40 less than 15% qualify for that same type of guaranteed defined benefit income stream.
15%.
They are almost exclusively reliant on defined contribution plans, which are your 401ks and IRAs. And this shift represents a fundamental risk transfer.
It's huge.
The burden of all the investment decisions, all the market volatility, and the longevity risk, the risk of outliving your money, it is entirely shifted from the corporation to the individual employee.
So just to spell that out, if I'm a millennial worker, that means I personally have to manage my own investment portfolio for 40 or 50 years, making sure I don't outlive my savings, all while I'm trying to pay off massive student debt and save for that 19-year down payment.
Correct.
But if I'm a boomer, the company takes on that risk and just delivers a monthly check starting at 65. I mean, that is a fundamentally different psychological and financial foundation to build a life on.
It creates a massive disparity in just the required savings targets. A defined benefit plan acts as a foundational floor for your retirement. A defined contribution plan, on the other hand, it requires sophisticated financial literacy and an aggressive, sustained savings rate.
Which, as we've already hinted, is being completely undercut by these crushing cost pressures.
Exactly. The fact that the boomers had both an affordable entry into housing and a guaranteed income floor in retirement is what made their wealth accumulation truly, and I mean this, an unrepeatable event. Their position was supported by both the post-war growth and these incredibly favorable policy shifts toward capital ownership.
Okay, so we've established the boomers' massive head start, which was built on affordable assets and this guaranteed security. But if that advantage was built primarily on cheap housing, what happens when we look at the cost of entry for everyone who came after?
Well, the data shows the structural disadvantages in the housing market are now, they're acute.
And our data sources are, you said it before, unequivocal on this point.
They really are. For younger generations, that initial entry barrier it's mutated from what was a manageable step into a near vertical wall.
So let's get straight to that core metric you brought up in the intro. The time required for a first-time buyer to save for a deposit.
This one number, I think, represents the most profound shift in the time horizon required to achieve stability.
Okay.
So, back in the 1980s, a typical young family needed approximately 3 years of saving to accumulate enough money for an average home deposit.
3 years.
Today, that saving period has exploded to 19 years.
And we have to stress the context of that 19-year figure. This model, it isn't assuming the household is squandering money on lattes and avocado toast.
Not at all. This assumes the household is putting aside a disciplined 5% of their disposable income annually. It uses the median first-time buyer debt ratios.
A disciplined savings rate for nearly 2 decades just to reach the starting line. I mean, that is financially and psychologically exhausting.
It really highlights the severity of rising house prices relative to stagnant wage growth and these very tight credit conditions. The housing ladder, it hasn't just gotten taller. It's become nearly impossible to climb without some kind of external intervention, like a significant parental wealth transfer.
The bank of mom and dad.
The bank of mom and dad. And this delay, it immediately forces millennials and Gen Z into insecure and expensive housing options. This is what we call the cost of waiting.
And that cost is quantified really well in the housing cost-to-income ratio, the HCIR. What does that data tell us about how much of their paycheck is just being consumed by having a roof over their head?
The HCIR is a great measure. It's the average share of your income that you spend on ongoing housing costs. On average, millennials spend 23% of their income on housing.
23%, okay.
Now, compare this to the 17% that baby boomers spent at the same age. And if we look even further back, the silent generation only spent 8% of their income on housing costs in their youth.
8%? Wow.
So generation on generation, housing costs have just absorbed a dramatically larger share of family income. It acts as this massive, persistent drag on your disposable income and your ability to save for anything else.
And that drag is amplified based on whether you own or you rent. You mentioned something called the private renter penalty.
Yeah, the growing affordability gap between tenures is a major structural driver of inequality. Our data shows that mortgage owners today spend around 12% of their income on housing costs.
That sounds pretty manageable.
It does. However, private renters are paying 3 times as much, 36%.
36% of their income just on rent.
Yes. That's a staggering 24 percentage point gap between an owner and a renter. And that gap has only widened since the 1960s and 70s, when the difference was only about 5 percentage points. Renting today is not a temporary bridge to ownership. It is a massive financial penalty.
And that penalty is compounded by just how precarious the modern rental market is. Our sources say millennials are 4 times more likely to be stuck in private renting at age 30 than boomers were.
4 times more likely. And the security of tenure itself, it's just vanished.
What do you mean by that?
Well, historically, many tenancies were regulated or controlled. This meant landlords faced significant hurdles to evicting tenants unless there was a really serious breach of contract. Sometimes tenancies could even be passed down through a family.
So you had stability.
You had stability. That security allowed renters to form stable communities, to raise families, without this constant fear of sudden displacement.
But now we have the modern standard, the assured short-hold tenancy, which was introduced in the late 1980s.
Which is defined by instability. It allows a landlord to ask a tenant to leave with just 2 months' notice, often for no reason at all other than they want to raise the rent or sell the property.
So every year, you're wondering if you'll have to move.
Exactly. And when you combine that 36% housing cost ratio with the constant threat of having to move every 12 to 24 months, it makes accumulating savings or planning for the long term incredibly difficult, especially for families trying to raise young kids. The stability that's necessary for upward mobility has been extracted from the system.
Okay, but here's where the numbers get a little complex. And this addresses a huge point in our sources about the lucky few millennials who do manage to buy a home. The data shows they actually enjoy lower interest costs than their parents did.
Right.
That seems like a paradox if affordability is the central problem.
It is a critical paradox, and it's rooted in debt amortization. We need to be really clear about this for you listening. Millennial owners with mortgages, they do have lower interest costs compared to boomers at the same age.
Lower interest?
Yes. Boomers and Gen X owners spent closer to 20% of their income just on interest payments at age 30. For millennials, that equivalent figure is about 15%.
And why is that?
It's a direct result of the historically low interest rate environment we saw for years after the 2008 financial crisis. It kept borrowing costs really low for nearly a decade.
Okay, so their loan is cheaper, but their overall housing outlay is still massive. Why?
Because the purchase price has skyrocketed.
Yeah.
The principal is so much larger. I mean, think of it with a simple analogy. The price of the sandwich has quadrupled.
Okay.
So even if the interest rate on the loan you take out to buy that sandwich is low, say 3% instead of 8%, you are still borrowing so much more money that the sheer size of the loan, the principal, just starves your cash flow.
So boomers paid high interest on a small base of debt, and millennials are paying low interest on a massive base of debt.
That's it, exactly. While the interest component of their payment is lower, the proportion of their income they are forced to spend on principal repayments, the capital repayment itself, has risen relentlessly. The most recent Gen X cohort spent 13% of their income on principal repayments at age 35. Compare that to only 3% for the last boomer cohort.
Wow, so that's where the money is going, not to interest, but to just paying down this enormous debt.
Precisely. It means that even if the interest part is small, the total housing outlay interest plus principal for young owners is still punishingly high because they hold such massive debt relative to their income. The debt treadmill starts much earlier in life, and it spins much, much faster.
And the compounding effect of this deferred ownership seems really clear. You have less time for that asset appreciation to accrue, less opportunity to build wealth, and critically, less opportunity to save for retirement because you're paying off your mortgage later and later in life. You could be making mortgage payments well into your 50s and 60s.
And those are years that should be your peak retirement savings years. The data really supports the view that delayed home ownership fundamentally constrains all other forms of saving. It ensures that even in the most optimistic scenario, achieving financial security will just take longer and require far greater personal sacrifice than it ever did for previous generations.
So we've established this massive housing hurdle, which blocks wealth creation through assets. Now, let's pivot to the other half of this financial stress equation. Everyday purchasing power for the youngest cohort, for Gen Z.
Right.
Because when older generations suggest that, younger workers simply need to cut their discretionary spending, the data presents a devastating counter-argument that's rooted in essential costs.
The numbers confirm it. The financial landscape for a young person entering the workforce today is just drastically different from when their parents or grandparents started out. We have to return to that core purchasing power statistic.
The big one.
Gen Z dollars today have 86% less purchasing power than the dollars held by baby boomers when they were in their 20s.
86% less. That figure represents a collapse in economic value. So if it's not just avocado toast, what are the specific costs that are driving this extreme deficit, way above overall inflation?
The sources all point to these sharp, exponential increases in non-discretionary expenses. These are the required costs just to participate in modern society. For example, since the 1970s, public school tuition has increased by 310%.
310.
Private school tuition, 245%. These are costs necessary for education, for career advancement. You can't just opt out.
And even just mobility, the basic ability to get to that job you were educated for, that's exponentially more expensive too.
Absolutely. Transportation costs are a major factor. Gen Z and millennials are paying 57% more per gallon of gas than baby boomers did when they were in their 20s.
57% more.
So when you combine these crushing housing costs with exponentially rising costs for education and necessary mobility, it just creates this immense financial burden that eats away at any potential real wage growth you might see.
And this feeds directly into the major headwinds the sources identify for millennials and Gen Z. These massive student loan balances, high inflation, and ultimately weaker real wage growth overall compared to that post-war era. The system itself seems to be pushing wealth creation further and further out of reach.
And this is where the deeper economic commentary from our sources comes in. Many of them attribute this enormous gap to systemic issues, specifically a concept they call the financialization of the economy.
Okay, that's a huge, complex term. We can't just drop that without exploring what the data suggests that it actually means for the average worker. What is the mechanism of financialization that has, as one source put it, ruined an entire generation?
Financialization, in this context, refers to the structural shift in the economy that really started around the 1970s. It's where wealth generation and corporate profits shifted away from production, from wages, from capital reinvestment.
And towards what?
Towards financial activities, asset appreciation, shareholder returns. The data shows wage growth decoupling from productivity gains, starting right around the 1970s.
Okay, so a company's productivity might rise by, say, 10%, but workers' wages only rise by 2%. Who is capturing that remaining 8%?
The owners of capital, the shareholders. And this was accelerated by major policy shifts, deregulation, changing tax codes, and the rise of this idea of shareholder primacy. That means CEOs are primarily incentivized to maximize short-term stock prices through things like stock buybacks and cost-cutting,
rather than investing in long-term wage growth or stable employment for their workers.
Precisely. The resulting structural dynamic ensures that those who enter the economy today, they have to battle this persistent environment of asset inflation, which is driven by capital accumulation, the very assets the boomers hold in abundance, combined with real wage growth that is just stagnant compared to the previous era.
So the economic rules actually changed. In the boomer era, you built wealth primarily by earning a strong real wage and buying an affordable home. But post-financialization, you build wealth primarily by owning existing capital stocks and property that is perpetually being inflated by easy credit and this corporate focus on maximizing shareholder value.
You've nailed it. The core issue is that while the stock market was propped up, especially after 2008, the benefit of that accrued primarily to those who already held substantial capital. Young workers, buried under student debt and high rent, simply cannot access that capital base early enough in life to ride the same wave of compounding appreciation that defined the boomer generation's success.
It sounds like the data is suggesting that to be truly wealthy today, you have to own a substantial stake in capital, likely multi-millions, which is just unattainable for most middle-class earners, no matter how well they budget or how good their personal financial habits are.
Yes.
The foundations of the middle class, an affordable home, and reliable real wage growth, those are now the biggest drains on their finances.
It completely shifts the entire definition of what it means to be middle class. If the costs of education, housing, and healthcare inflate far faster than wages, and the standard inflation metrics we see on the news, the economic experience of millennials and Gen Z, even if they have potentially higher nominal salaries than their parents.
Their lived experience is different.
Their lived experience is one of constant catch-up, always running just to stand still.
All right, now we need to execute the reality check. We're going to use the very recent market data from the Q3 2025 Wealth Watch report, we've established the historical gap, the structural disadvantages, but are the younger generations managing to claw back any significant ground right now?
The Q3 2025 snapshot does show some positive momentum, which is important to note. It was a strong quarter overall for investors, driven largely by market performance.
Okay, some good news.
Some good news. Retirement savers made notable gains. Average retirement account balances climbed 4.5% overall, just from Q2 to Q3. Specifically, Roth IRAs, which are typically favored by younger, lower tax bracket workers, they showed the largest relative increase, up 6.6%.
So the young people who are saving are doing a good job of it. But what does that mean for net worth across the generations? Are millennials and Gen Z actually closing that percentage gap?
They are showing the greatest percentage quarter-over-quarter growth rates, which is positive. Gen Z clocked the greatest gain, up 7.5%, followed closely by millennials, up 8.1%.
And the older generation?
Gen X was up 5.4%, and boomers were up 3.7%.
Those are impressive percentage gains for the younger cohorts. I mean, 8.1% in a quarter is fantastic. However, since the primary critique here is the vast difference in the base of wealth, let's look at the current average net worth figures as of Q3 2025. That should show us how immense the gap still is.
And it does. The magnitude of the wealth gap remains immense, and it really reinforces that concentration we talked about earlier. As of Q3 2025, boomers average $1,554,643.
Over $1.5 million.
Gen X averages about $1.1 million. Millennials average $330,126. And Gen Z averages $93,139.
So while Gen Z and millennials saw the fastest percentage growth, it's the classic small base effect. A 7.5% gain on $93,000 is, it's still negligible compared to a 3.7% gain on $1.5 million.
Exactly. The structural gap is not closing rapidly at all.
So what specifically drove those market gains in Q3 2025? It sounds like equities were the main engine.
Equities were on a tear. The indices reached new heights, making investors across the board wealthier. The Russell 2000, which tracks small-cap stocks, was the best performer, up 12% for the quarter. The NASDAQ composite was up 11.2%, and the S&P 500 gained 7.8%.
And housing.
Crucially, home prices also continued their upward momentum, which mostly reinforces boomer wealth. The median U.S. home sold for about $370,000, up 1.2% quarter-over-quarter. Sellers were realizing nearly 50% profit margins on their home sales.
Which is great for them, but it just solidifies the wealth of those already on the housing ladder and makes the barrier for new buyers even higher.
It does.
So, okay, we have millennials and Gen Z making strong percentage gains in the stock market, which is great to see, but those gains are only half the story. If their savings are up 8%, but their credit card debt is also hitting new record highs, are they genuinely getting ahead? Or is this just a debt treadmill? Let's do the debt reality check.
The debt side of the ledger provides the crucial context for those percentage gains. The Q3 2025 report shows that household debt overall increased by $197 billion in that one quarter. It reached a total of $18.59 trillion.
And credit cards.
More alarmingly, credit card balances alone reached a record $1.23 trillion. That's up $24 billion quarter-over-quarter.
That's staggering credit card balance. I mean, it's not just reckless spending, is it? It feels like the inevitable consequence of a dollar that buys 86% less than it did a generation ago.
I think that's right.
They're using high interest debt just to cover the massively inflated non-discretionary costs we talked about. Housing, education, transport.
The data supports that conflict. They are showing discipline by investing, in their Roth IRAs and benefiting from market growth, but they are simultaneously battling a cost of living crisis that is forcing them into this high-interest revolving debt just to cover essential expenses.
Yeah.
It's a push-pull scenario that severely limits their ability to build any kind of sustained, unencumbered wealth.
And even if young people somehow manage to buy or rent, the data suggests they're making these fundamental quality of life compromises that previous generations didn't have to. It's not just about money anymore, it's about space and time.
Let's talk about the compromise on space. While housing quality has dramatically improved over the decades, in terms of space per person, households headed by someone under 45 are net losers.
Net losers in space.
Yes. Members of these households are enjoying 3% less space per person than a generation ago. This is often due to sharing or living in smaller, denser apartments or homes.
What about older households?
In contrast, over 45s are net gainers. They are enjoying 4% more space on average than they did 2 decades ago, which reflects the ability of older generations to trade up or simply remain in their larger family homes after their children have left.
So the wealth gap translates directly into a space gap. Less personal space, less room to raise a family, less security. And that loss of space is compounded by the loss of time because of increasing commute lengths.
This is a clear quality of life penalty tied directly to the affordability crisis. Millennials have demonstrably longer commutes than older generations did at the same age. We estimate that millennials will spend 64 hours, that's close to 3 full days, more commuting annually in the year they turn 40 than boomers did at that age.
3 extra days a year just sitting in traffic.
And that's crucial, because time spent commuting is time lost to saving, to family, or just to rest.
Is that penalty evenly distributed? Or does it hit lower earners harder?
The data is very clear on this. Low-earning millennials are spending significantly more time commuting than low-earning Gen Xers at the same age. High earners, they generally track closer to their predecessors because they have the capital and the flexibility to live closer to urban centers and job hubs.
So the people with the least money are paying the highest price in lost time.
It's a vicious cycle. For those on lower incomes, the sheer necessity of finding cheaper, available housing is pushing them further and further out of cities. This results in a disproportionate cost in terms of both time and gas expenses. Housing affordability dictates their location, and their location dictates this massive loss of valuable time.
So the tightening of the economy, the rise in asset prices, the high debt levels, it all translates directly into less security, less savings, less space, and less free time for the younger cohorts.
The evidence is just mounting that the structural advantages that were previously enjoyed are gone. They've been replaced by structural penalties.
The structural barriers are, they're undeniable. We've seen the $82 trillion advantage that was built on affordable housing and surging stock markets. And it's countered by an 86% deficit in purchasing power and this 19-year deposit saving period for the younger generations. To wrap up our data investigation, let's just revisit the long-term outlook based on the economic modeling in the sources.
So to summarize the projections, we analyzed a few scenarios based on historical economic performance. The data shows that even in an optimistic scenario, where economic conditions mirrored the highest growth decade for homeownership, that's 1981 to 1991.
The best case?
The best case. Even then, millennials would still reach homeownership levels that are 6 percentage points lower than the boomers by age 45. So even a favorable market doesn't fully bridge that gap.
And what if we repeat the difficult conditions of the more recent past, like the post-2008 era?
Well, in the pessimistic scenario, which modeled the poorest performing decade for homeownership, that's 2002 to 2012 conditions, a time with rising house prices and tightening credit, we estimate that less than half of millennials would buy a home before the age of 45.
Less than half.
Contrast that with 70% of boomers who had already done so by that age. In that scenario, renting becomes the permanent majority tenure for the younger generations, which would just accelerate the wealth divergence we've spent this whole time documenting.
The evidence is overwhelming. It compels us to ask the defining question of this era, the one that connects all these past and present findings. Is the ladder being pulled up?
Structurally, the answer seems to be yes. And it's really important to recognize that this is a majoritarian problem. The decline in homeownership is not a niche issue affecting only the lowest earners.
No, it's across the board.
It affects all income groups and all regions. We saw ownership rates for young families roughly halve across every single income quintile since the mid-1990s. This is a systemic redefinition of who gets to be an owner in our society.
And the consequences, they ripple out far beyond just the initial purchase. Delayed home ownership means less time for that asset appreciation to compound. And critically, less opportunity to build retirement savings, as millennials might be paying off mortgages well into their 50s and 60s.
Years, that should be their peak saving years.
Exactly. Even in that optimistic growth scenario, fewer millennials will own their own home by the time their first child turns 5 than previous generations did. The struggle just starts earlier, and it lasts so much longer.
The system has created a profound divergence. Those who inherited the structural tailwinds are now sitting on this unprecedented wealth, primarily in housing and investments. Those who followed are facing insurmountable barriers to entry, high-cost debt, and a lifetime of security compromises.
Which leaves us with one final provocative thought for you, the listener, to mull over as you digest this massive data set. We know the baby boomers have accumulated this immense multi-trillion-dollar trove of wealth, mostly tied up in housing equity. This wealth must eventually be transferred.
It has to go somewhere.
So the final question is really twofold. First, will this inheritance be consumed by late-life social care and spiraling medical costs, or will it actually be bequeathed to the next generation?
And if it is bequeathed, will it actually resolve the housing issue for younger families by bridging that massive 19-year deposit gap? Or, and this is the key question, because that transfer typically happens after the inheritor is already in their 50s.
Right, it comes late.
Will it simply reinforce already existing wealth inequalities, benefiting those who are already established, and potentially arriving too late in life to truly benefit those who are trying to raise young children or fund their own retirement?
The intergenerational wealth transfer, the fate of that $82 trillion trove, is the ultimate wild card that will determine the financial trajectory of millennials and Gen Z for decades to come. An essential question, and one we will certainly return to as the data evolves. Thank you for joining us on this deep dive into the generational wealth gap.